Hey, welcome back, traders. It's John at Rain King LLC. Time for a general market update. As a reminder, I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. So here's our agenda today. We'll go over the market environment, the internals. We'll have a deeper look at some of the groups, trying to find where is the strength. And then we'll talk a little bit about the Fed and the regional bank situation and a summary. So the market environment. This is a weekly chart of the S&P 500. No major changes from last week. We did come back and touch the 50-day, but we're still above the 50-day and the 200-day, which are represented here on the weekly charts. And currently, the S&P is still underperforming the NASDAQ. Here is the chart of the NASDAQ composite. I've shown this chart a few weeks in a row about these selling declines, number 1, 2, and 3. And I had said for a few weeks, if we came back and touched the 50, that wouldn't be the end of the world. I will say that this looked really, really bad here when we came back to the 50. That was very, very ugly. But somehow the market rallied again back into the resistance area that we've been experiencing. And then this early part of this week, again, was very, very bad. Here it also looked pretty nasty with the bank failures and the other banks that are under stress. But somehow today, when I'm recording this about 1 o'clock on Friday, we've managed to launch higher back up into this resistance zone. So it's still a very mixed picture. On the internals, this is the advanced decline line for the New York Stock Exchange. You can just see the point of this chart is to show this is the S&P in the upper panel. You can see we've run up against these resistance areas multiple times. The difference is the advanced decline line sold off sharply in February and March, and these rebounds have shown poor breadth. And what we mean by that is, even though the index was trying to push to new highs, the advanced decline line is well below its peak that it reached in January. And the last rally attempt that we had back up into the resistance area, the advanced decline has deteriorated even further. So that's just not a good picture. It's not what we want to see. This is the New York Stock Exchange, net new highs, new lows. And the picture, again, is further weakness. You can see that the net new lows are actually accelerating this past week. So it's just not the picture we want. It's not conducive to a bull market. And we need to be very, very careful about our exposure, if any, to the market. So this is a comparison chart, just trying to look at market caps to try and just point out that the weakness by market capitalization. Since the market peaked in February, early February, you can see that the small and mid caps really peaked out, and you can see they've been in a steady downtrend, and they're actually very close to new lows, the mid caps and the small caps. But as we've all seen, the larger cap stocks and the composite, the NASDAQ composite in pink, have been holding up a little better. They've been going essentially sideways after they moved up in the month of March, when there was the fear of the banking crisis and a lot of flight to some of the mega caps that had a lot of cash on their balance sheets. But you can also know that the Qs and the NASDAQ are showing that they're starting to roll down as well. We'll have to see if they hold. As we just looked at the composite, and it showed that today was actually an update so far. So let's go further into the groups, trying to say where are the groups strong and where is the weakness in the market. So the strongest groups, so when we're looking for strength, this is a comparison chart, and I've just pulled a whole bunch of basically defensive sectors. You can see the groups there. I'm doing this in MarketSmith, and you can see that since March, when the banking crisis started with Silicon Valley Bank, these groups have been where the strength is. It's not what we'd like to see as growth investors, but the bottom line is money is being parked in defensive areas of the market, into food, beverages, soap and cleaning preparation. And if you go deeper, you can see some of the names. It's Coca-Cola, Monster Beverage, some of the restaurants, affordable restaurants have been doing okay, including Wingstop, Chipotle, Potbelly. And you can see these other groups are probably symbols that you're not very familiar with because they're very defensive. Hershey, Clorox, Dole. So that's where the strength is right now. The XLP is reflecting that strength, and these are all defensive groups that are performing well. Now, if we want to look and say, where is the strength in groups that we're more interested in as growth groups, there is some strength in the market, though it's not dominant. You can see here, the purple line is apparel and shoes. Very, very strong relative strength since March. And I've just pulled a few symbols. This is Skechers, On, Deck, Lulu. They're holding up well. The green line here has also been holding up well, and this is the home builders. And we're going to go a little deeper into this group in a second, but there's a whole bunch of symbols in there that are holding up very, very well. The turquoise line here is the gaming group, gaming and equipment, and we've seen strength in Wynn, Las Vegas Sands, etc. So there is some strength here. It's just not dominating. It's really in the minority, but it is noteworthy to keep track of some of these groups and keeping track of groups that were strong at the beginning of the year, such as the semiconductors, which have really been hit hard over the past 6 weeks. So I'm going a little deeper now into the builders, the residential commercial builder group. And the black line is the ETF, HXB, which is the home builders. And you can see this is forming a long base for the past few months. Now, I pulled out a series of symbols from the home builders, and you can see that many of them had run-ups since last fall, October, November, came up, they formed stage 2 bases. And you'll notice if I draw a line here, some of these stocks have really broken out. Green Brick had a very strong earnings report and gapped up, very strong power earning gap yesterday. Morrison, DR Horton. So the leaders of the group have already pushed higher. They're extended now, so you have to watch them and see if there's any additional ways to potentially get in them if you're interested. But the entire group is setting up. Now, you might say, how are the builders doing well in a high rate environment? Again, the market is looking forward 6, 9, 12 months. So certainly the market is signaling maybe interest rates would come down in 6, 9, or 12 months, which would be really, really good for the builders. So that's why we're seeing some strength there, because they're anticipating. So if we go even deeper, I've called up 3 charts from the group just to make the point again. All of the home builders in October and November really hit their lows, and they all had a strong leg off the bottom. And then they've gone through some sort of consolidation or stage 2 base. You can see it in DR Horton, Green Brick. Here's that powerful monster and power earning gap from yesterday. It was up 23% on big volume. And then we also see Taylor Morrison Home. It's not easy because these had breakouts and they immediately failed. But if you got back in, you'd be rewarded. So it's not easy, but it's noteworthy that this group is actually probably one of the stronger in the market right now. So let's move on to the Fed and regional banks. So I've got 2 ETFs. On the left, I have the XLF, which is the financials, and on the right is the KRE, which is regional banks. Wanted to note that the lows in the financials was back in October and last summer. That's where the lows were, and we're still above those, which is positive and constructive. But you'll also notice that the regional banks have fallen off the cliff. They're in trouble. We're seeing more and more banks looking vulnerable. Now, the point I would like to make is just, right now, the large banks, the Morgan Stanleys and the Chases and some of the really big banks and the FDIC essentially are bailing out the regional bank failures in a combination of funding from both sources. If the XLF breaks these lows, this market, could be very vulnerable to another down leg in a bear market. So I think this is really worth keeping our eye on. And if anything changes with how these smaller banks are going to be dealt with, it could also impact the whole system. And again, Powell at his meeting on Wednesday, I believe he made a statement saying the banking system is safe. Kind of shocking because after hours, PacWest and Western Alliance banks were essentially nosediving because they seem to be the next 2 banks that are really in trouble. So, there really are some dark clouds, and no one knows where this regional bank situation is going to end. So let's talk about our summary. Last week I talked about heavy bearish positioning and, possibly could we get a move in the other direction? Hasn't happened yet. The PCE report, I thought maybe it might be a catalyst for the market with the Fed talking, but regional banks really started to dominate the news. It was not a catalyst. The Fed is basically saying they want more progress on the inflation front. It did give a hint that maybe it would pause to see the lag effects of all the previous hikes. Again, this statement about the banking system is safe is certainly a head scratcher. More banks are looking like they're in trouble. And I would just note that this kind of drip of bank failures is really bad for the markets because, it really breeds uncertainty. The markets hate uncertainty, and finding out in little drips one by one banks that are in trouble is not good for the market. It just really puts a cloud over things. And it also shows a lack of confidence in the Fed speak. They make these statements and, you have to wonder if when the Fed says the banking system is safe, they either don't know what the real banking situation is, or maybe they know more about the banking situation, but they don't want to reveal it because they don't want to say that this is going to get worse before it gets better. And maybe they prefer the drip and saying, don't worry, we'll handle them one by one from the dripping faucet. But it doesn't breed confidence, and the markets are reflecting that. Now, on the positive side to all of this is we have had a lot of bad news. This bank situation, earning blowups, et cetera, and the market has still not fallen apart. That is very, very positive. The market is still holding up somehow amidst a lot of bad news being thrown at it. So we talked about the strong groups. The stronger groups we're seeing are really defensive primarily. And you wonder if the market is really seeing this hard landing recession coming in the fall and winter. It remains to be seen. We'll have to see how it goes. But the main point is, look, we interpret what we see. Now, right now, the market does look vulnerable, and I'd be pretty cautious and really focus on protecting your account. But we're also open that things can change. So when it's clear there is clearly nothing to do, act accordingly. Growth stocks right now are not in favor in the market, so we wait. It's really that simple. We need to be patient and wait for the conditions to change. That's the general market update from May 5th. Have a great weekend, everybody. Here's where you can find me on Twitter, YouTube, and email. We'll see you at the next general market update.